The core part of most retirement plans, almost all retirement plans really, has a lot to do with how you're going to derive income from your assets after you retire and the paychecks stop coming. For some people, a core part of their retirement income plan might include Social Security benefits or pension benefits, something like that. But for the vast majority of Americans, they're saving for retirement in some mix of 401ks, IRAs, Roth accounts, taxable accounts, 403bs, that kind of stuff. And turning that big pile of savings into retirement income presents a challenge for a lot of people. And sometimes annuities can make a lot of sense, turning this big pile of savings into consistent income that an insurance company promises to give you every month for the rest of your life that you can't outlive. Now, if you're familiar with our channel or with me or our firm, you probably know that we're generally not huge fans of using annuities to build retirement income plans. Well, in today's video, what we're going to do is cover a few different ways to build retirement income plans, and then we'll go over a fact pattern where a specific kind of annuity really makes a lot of sense. We'll cover buying dividend paying stocks, using that to generate income. We'll cover using investment assets to buy a bond portfolio that generates interest and cash, and then we'll compare that to a specific type of annuity and go over when and why that might actually make a whole lot of sense. So stick around till the end. This is a good one and fills a lot of holes, I think, for a lot of people out there. So to start, there are a whole ton of different types of annuities. There are fixed annuities, there are immediate annuities, there are deferred annuities, there are variable annuities, there are index-linked annuities. What we're going to talk about today is the most basic form of annuity called a SPIA, which is an acronym, SPIA. This is just a very plain vanilla exchange. You give the insurance company money, they promise to give you money back for a certain period of time. Now, most often we think of this in the sense of that time frame being monthly for the rest of your life, or maybe the rest of you and your spouse's combined lives. But that's not the only option. When you purchase a SPIA and coordinate this with an insurance professional, there are a lot of different options. One option is a period certain, meaning for 10 years, that's what the insurance company is going to cut you a check for, or maybe 20 years. And what that means is that if you buy a 10-year period certain annuity, you give them money, they give you a check every month for 10 years, no more, no less. If you pass away, if you perish before the 10 years is up, the insurance company is still going to pay you. It'll just go to your estate or your beneficiaries or somebody else. But that also means that if you live longer than 10 years, the insurance company is going to cut those checks off 10 years down the road, no matter what. Now, the other option is whether if you're annuitizing for the rest of your life, is the insurance company going to pay you for the rest of your life or the rest of you or your spouse's lives, whichever one is longer? And in general, when you make selections in these policies, when you set them up that are more beneficial to you, that simply reduces the amount that the insurance company is going to pay you every single month. So if there's an option for the insurance company paying you for the longer of your life or your spouse's life, whoever lives longer, the potential for the insurance company to have to cut checks for a longer period of time is a lot higher. They're simply going to give you less money each month as a result. The downside of the annuity is obviously you're exchanging $100,000 or whatever amount you're annuitizing. You're exchanging that money for a check every month for the rest of your life, or perhaps for the rest of you and your spouse's lives. And when you perish, that's it. The payments stop, right? So if you're someone who has kids, maybe that you want to leave something to, it's not a good idea to annuitize any money that you want to leave to kids. It also causes the problem of access down the road. There are a million different reasons you might need to use some or all of that $100,000 that we're talking about. Maybe you or your spouse needs long-term care help. Maybe you need to move into assisted living or memory care facility. Maybe you have unexpected medical expenses. Maybe you want to change around your charitable giving or do something different there. Once you make this exchange, once you buy the annuity, that's it. You don't get to touch that money anymore. And that it can hamstring a lot of people. So while it can be a good fit because you can produce more guaranteed retirement income by doing it, just make sure that your You're not doing it with more of your savings than you're comfortable with, and definitely don't do it with any savings that you would like to pass on to other people when you eventually expire. So it's for that exact reason that SPIAs can make sense in some circumstances as part of your retirement income plan. Because the $1 million question for people who are saving in their IRAs and your 401ks is, do I have enough in there to last me the rest of my life? I don't know exactly what my expenses are going to be 10 or 20 years down the road. I don't know whether I'll need long-term care services or what my health care will cost. I don't know how long I'm going to live. I don't know, what's going to happen with the rest of my family. I don't know whether this savings, this nest egg that I've built up is going to be large enough to last me the rest of my life. That's why a SPIA can sometimes be compelling. You can give some or all of that to an insurance company, and in exchange, they can write you a check every month for the rest of your life. That's why some people incorporate it into their retirement income plan. So in the next section, let's compare a couple of different options. Let's take a look at if we have $100,000 that we want to turn into retirement income, what are some ways to do that? We could invest in dividend paying stocks, we could invest in bonds, or we could explore how much we might get through a SPIA, a single premium income annuity, and then we'll talk about why there are differences. So one popular option for building retirement income with your investments is to purchase dividend paying stocks. You take cash, you buy one or a group of stocks, and sometimes stocks will pay you dividends, and that cash from the dividend gets deposited into your account. Now, how the size of dividend that you get depends on the company. It depends on its growth aspirations. It depends on its performance and so forth. And there's this spectrum involved here of growth companies to value companies. Growth companies typically don't pay you much of a dividend. So think of tech companies like NVIDIA is a good example of that. NVIDIA has a corner on graphics cards and chip interfaces that are particularly useful for AI. And they're trying to grow really rapidly. They have a lot of market share, they have a lot of revenue, and at the end of the year, when NVIDIA takes a look at all its revenues, and then it takes away its expenses, if it's looking at its income statement, it has revenues at the top, then it subtracts out its expenses, and then it has profits left over at the end of the year. NVIDIA is not using that cash to distribute a dividend back to shareholders. NVIDIA is taking it and reinvesting it back into the company aggressively because they want to grow. Well, other companies do it differently. Usually more mature companies, I would say, that are maybe less innovative and have a more stable and mature business model. So Coca-Cola, Altria, Procter and Gamble, those types of companies, they have their revenues at the end of the year. The CEO and the CFO get together, they review the financials, they have revenues, they have all their expenses, and then there's money left over at the end of the year. Well, the executives there at these companies know that they're not growing as fast as NVIDIA is. They don't have the same level of innovation. They're not at the bleeding edge of technology like some of these growth companies are. So because they're not growing as fast, they know they need to distribute at least some of that cash back to shareholders in the form of a dividend, because that return is what they're expecting. So this method of investing in companies that pay a consistent dividend is a way to raise cash that could be used for income in retirement, right? So let's go through an example. Let's say that you have $100,000 in as part of your nest egg. You want to turn that into retirement income. What I'm going to do is throw up on the screen a history of SPY and its dividend distributions over the last, looks like 30-ish years, somewhere around there. So SPY is an ETF. It tracks the S&P 500 index, or the largest 500 corporations here in the United States. If you own that ETF, you by default own a little bit of every single one of those companies. Well, those companies pay dividends. And right now, the distribution yield on SPY is 1.17%, which means that if you purchase $100,000 of this ETF over the course of the year, you might expect to get around $1,170 in dividends. That's cash deposited into your account. So if you go forward with this plan, you take $100,000, that could result in $1,170 in retirement income on an annual basis. Now, before we get too far down the road, this is just the 500 largest corporations in the United States. It's not focusing on dividend companies necessarily. It's going to be relatively heavy in a lot of these growth companies like NVIDIA and other tech leaders that don't pay a dividend. So here's what the distribution yields look like for a dividend-focused fund instead of just the bulk S&P 500, which includes some dividend-paying stocks and some non-dividend paying stocks. This security is it's an ETF. It's managed by Charles Schwab. The ticker is SCHD. It's going to focus more on the value side of the spectrum, and its dividend yield is currently 3.88%. So if you put $100,000 into this fund, you might expect around $3,880 in dividend distributions throughout the year. Now, why do I say around? It's because this method of developing retirement income is really kind of fallible. Companies distribute dividends, the companies that distribute dividends are not compelled to. And usually if we hit a recession or if we hit any kind of financial headwinds or these companies run into trouble, the very first thing that they do is cut their dividend. So this is using dividend paying stocks to build retirement income is about as far from guaranteed as you can get. And on top of that, using just dividends you're missing part of the picture, because if you take some of your retirement income and you buy one company, let's say Coca-Cola, because it provides a nice dividend, well, Coca-Cola might go up in value. The price of the stock and the shares might go up as the company drives more profits over time, and that's a part of your return. So what we're assuming here is you take cash, you buy a stock or a fund, and then you just sit back and collect the dividends, when realistically you could use part of that long-term return as part of your retirement income. And this is when you get into long-term distribution rates of return, the 4% rule, Guyton's guardrails, and other things that we have a ton of videos on here on our channel that you can check out elsewhere. The same can be said for bonds. So if we buy a bond, we take that $100,000 that we're talking about, we purchase a bond, which is basically a loan to another organization, and then that bond shows up in our account the next day. Well, from that point forward, the issuer of the bond typically pays us interest every 6 months. And then when the bond reaches maturity, the bond matures, it goes away, the borrower reimburses you, they give you that $100,000 back, and then the deal is over. So these days, you can purchase highly rated bonds, meaning very low chance that the borrower is going to default, and get somewhere between 4 and 5% interest every single year on like a 10-year bond. You could also buy a fund, which is a whole portfolio of bonds. And typically in a fund, in a portfolio of bonds, that's going to be an indefinite time frame, because the bonds within the fund are going to mature at different times. The portfolio manager is going to continue reinvesting that cash on your behalf. So what that means is if you take that $100,000 and as part of your retirement income plan, you buy one bond, then that bond will pay you interest until it matures, and then it will go away. But if you buy a fund and a group of bonds, the manager is going to continue reinvesting on your behalf. And right now, let's take a look at SCHZ, which is a Schwab product. It's an exchange-traded fund, an ETF that simply tracks the U.S. aggregate bond index. And as you can see, the dividend distributions are very, very close to 4% per year right now. So the bonds in this fund, in this portfolio, pay interest to the fund, and that interest is then distributed to you as a shareholder in the form of a dividend, which is very similar to collecting the interest directly from the underlying funds. So this is a reasonable way to build retirement income too. You might ask, well, why would I ever buy stocks that are focused on dividends that only yield less than 4% when I can buy bonds that yield more? And the reason is, with bonds, yes, you might get a little bit more interest in the aggregate, but you don't have as much long-term upside. Stocks are a portion, a small ownership of the corporation itself, and the value can go up based on how that corporation does. The bonds are just a loan. They might go up and down in value, but if that company does very, very well and its stock goes to the moon, you're not going to benefit from that as much as a bondholder. So they're two very different things, but bonds can be used to produce nice retirement income streams just like stock dividends can. So just to compare, you have $100,000. Let's say you buy an S&P 500 index fund. The dividend yield is about 1.17%. You might benefit from appreciation, the value of those holdings. That dividend yield could go up or down. And with your $100,000 investment, that might net you about $1,170 a year, or about 98 bucks a month. Well, you could also invest, instead of just in the S&P 500 that contain some dividend paying companies and some non-dividend paying companies, you could invest that same $100,000 in stocks and have some upside, but target a group that only pays dividends. Target only a group that pays dividends. The yield is going to be higher, closer to 3.88%, which is $3,880 a year, or about 323 bucks a month. Now, if that's too risky for you, you could also purchase some bonds, right? So you take $100,000, you buy a fund that tracks the U.S. aggregate bond index. The yield is about 4%. That's about $4,000 a year, or about 333 bucks per month. Now, realistically, what most of us are doing in our portfolios is having a balance of all of these things, right? Because the money that we're using to invest to produce retirement income, again, we can rely on some of the long-term gains to produce those distributions we'll need 10 and 20 years from now. We're not just holding on to the investments, waiting for those investments to produce cash and then taking out only the cash. We can take out some of the principal or growth over time, circumstances depending. So where do annuities fit into all this? Well, let's say instead you take that $100,000, you give it to an insurance company, and you purchase a single premium income annuity. Well, when you do that, you're pooling your mortality risk with thousands and thousands of other policyholders. And when you give the $100,000 to the insurance company, their team of actuaries want to know how likely it is that you live another 5 years, another 10 years, maybe another 30 years. Because if you're 60 years old and you buy one of these things and then you live to 100, the insurance company is going to have to cut you monthly checks for 40 years. That's like the worst case scenario for the insurance company. If you buy one of these things and then you perish 2 years later, they only have to pay you 24 total checks, right? Monthly checks over 2 years. So what they're able to do is pool mortality risk. And since there are thousands of people buying these products, they can mitigate the risk of that entire group living to 100 and pass some of that risk pooling back to you in the form of a larger monthly check. So rather than you taking that $100,000 and buying bonds and getting $4,000 or $4,500 a year, you can pool that risk with other people and collect more from the insurance company. And spoiler alert, what the insurance company does with that $100,000 is not very different from what you or I would do. They take that $100,000, they invest it in bonds, just like we're talking about within our own accounts. But because you're pooling that risk with thousands and thousands of other people, they're able to pass that on in the form of what are called mortality credits. So the numbers on this, and I just ran some quotes as if I were a healthy 60-year-old man in California, and all of that is relevant. The life expectancies state to state around the country differ just a little bit, and your gender has a bearing on how long you might live as well. Insurance companies want to know that to figure out how much they can pay you in one of these products. So I ran a quote for $100,000 healthy 60-year-old man in California, and from a reputable company, you can probably find one that pays you $570 or $580 a month for the rest of your life. So that's immediately a substantial raise from the $333 that we were getting by investing in a bunch of bonds, right? So that's where single premium income annuities can make sense, is if you're trying to take this pile of assets and convert it into retirement income after you stop working, you can squeeze more guaranteed income out of it by purchasing one of these products than you can by just living on the interest from dividend stocks or bonds. The downside of the annuity is obviously you're exchanging $100,000 or whatever amount you're annuitizing. You're exchanging that money for a check every month for the rest of your life, or perhaps for the rest of you and your spouse's lives. And when you perish, that's it. The payments stop, right? So if you're someone who has kids, maybe that you want to leave something to, it's not a good idea to annuitize any money that you want to leave to kids. It also causes the problem of access down the road. There are a million different reasons you might need to use some or all of that $100,000 that we're talking about. Maybe you or your spouse needs long-term care help. Maybe you need to move into assisted living or memory care facility. Maybe you have unexpected medical expenses. Maybe you want to change around your charitable giving or do something different there. Once you make this exchange, once you buy the annuity, that's it. You don't get to touch that money anymore. And that it can hamstring a lot of people. So while it can be a good fit because you can produce more guaranteed retirement income by doing it, just make sure that you're not doing it with more of your savings than you're comfortable with, and definitely don't do it with any savings that you would like to pass on to other people when you eventually expire. Annuities, because you're giving up all control to insurance companies. And also keep in mind that the examples that we went through today is just one very basic type of annuity product, a single premium income annuity. Usually these things are more elaborate and ornate, and in my experience, the more bells and whistles and features they have, the more expensive they are, the better they are for the insurance company, and the worse they are for you. That doesn't mean that you should always steer clear of them. Just be aware of what you're getting yourself into, because when you purchase that annuity, that's a very heavy decision. You're giving up a lot of flexibility and control in exchange for that promise of retirement income later. Hey everybody, real quick, if you're someone who's saving for retirement and you're wondering how much you need saved up in order to retire, there's a whole bunch of different rules of thumb that you can use. Unfortunately, none of them are very specific or very good for our own financial planning purposes. If you're there wondering how much you need to retire, we built a 2-minute quiz you can fill out anonymously, and we'll email you the result of some rough numbers you might want to consider. As always, it's not advice, but maybe it's a point in the right direction. Click the link below here in the description if you're interested. Again, it won't take you any more than 2 minutes.